Good morning, everybody. My name is Dirk Schoenmaker from Bruegel, and I will be moderating this panel. So we have a small group, but that means that we can have a real discussion. So that's always good news. And we have two speakers today. First is Anatoli from the Banca D'Italia, from the Financial Stability Department. He will present the paper. And then Benjamin Friedrich from EBA, European Banking Authority, will be discussing. And the official title is Integrating Stress Tests within the Basel III framework. And I think the real interesting underlying idea is, can we do countercyclical macroprudential policy? And just to start off, we had a discussion at the European Commission because they are reviewing the framework. So there is a consultation period, and they had this public hearing. And then I would say that 3/4 of the audience, including central bankers, were all skeptical. So we only do macroprudential for resilience reasons, so you make the buffers higher when the bad weather is coming, but you don't make it lower when needed. That's a true counter-cyclical thing. And I was quite disappointed with that, because I really think, just as a kick-off, if 11 out of 10 crises are housing related, then, and housing is all about boom bust, then, and we all know that the interest rate cannot do it on its own, monetary policy, there is an extremely strong case for countercyclical policy. Ireland, Spain, US. So in that sense, I think the presentation today is extremely timely, because if we can really do proper countercyclical, then if we can use it really as a good tool, then we can be more proactive on that front. And against that background, I would like Anatoli to ask to start your presentation.
Thank you very much, Dirk, and thank you. I want to thank the Institute Bruegel for inviting me to present this work with one of my co-authors at the Banca D'Italia, Pierluigi Bologna. And so the presentation is based on an occasional paper of the Banca D'Italia that has been recently published, whose title is pretty self-explaining. Integrating stress tests within the Basel III capital framework, a macroprudentially coherent approach. It's not a very sexy title, but it is pretty self-explaining at least. So the first thing I have to say is that the usual disclaimer applies. The views I'm going to express in this presentation are my own and do not necessarily coincide with those of Banca D'Italia. And if you want, a second disclaimer is that I work in the economics department of the Banca D'Italia, in the Financial Stability Division. I have not been ever involved in conducting stress tests. So what we have done in this work with my co-author Pierluigi is more of an outsider conceptual reflection based on economics, on how stress tests should be integrated into the Basel III framework. So I'm very happy that Benjamin is here to discuss our work and to provide his insider view on the issue. So I think these two opposed views may be very valuable. So why are we talking today about macroprudential policies, about Basel III instead of Basel II, and about stress tests? So it has obviously to do with the events in the past crisis. So in the run-up to the great financial crisis, the balance sheet of financial intermediaries expanded very aggressively, and banks increased their leverage and their maturity mismatch. They were funded with ever shorter and shorter debt funding. And this happened contemporaneously with the market perception of very low risk. consequence of the spreads of all very wide range of different securities and very compressed risk premia. Then all of a sudden in August 2007, when the initial losses related to those at the time weird subprime assets were realized, the situation suddenly reverted. Banks experienced funding problems in wholesale debt markets, which led to fire sales and ever-increasing illiquidity in secondary markets, and this led banks to delever all at the time, propagating contagion and distress first within the financial sector and then to the rest of the economy. We all know that there was the need of massive public interventions in terms with a very important cost to the taxpayer, explicit when it comes to bailouts and implicit when it comes to the impact on the real economy of the inability of impaired banks to perform their vital role in the economy as credit intermediaries, and this gave the necessary push to engage in an important regulatory reform of the financial sector, motivating many of the elements of this reform. There is the macroprudential objective of enhancing financial stability and reducing the volatility of the financial cycle. When it comes to banks that are crucial in the financial sector, especially in Europe, the post-crisis banks' capital adequacy is established with two novel instruments, the Basel III capital standards and also supervisory stress tests. And both of them have some macroprudential dimension. So let me say a few words on each of these two instruments. Basel III standards with respect to the Basel II capital framework has increased the quantity and quality of minimum capital requirements and has also introduced or also requires banks to build buffers, as Dirk said, during expansions, whose aim is allow banks to have some cushion to absorb losses without engaging in the leverage during downturns. So, in particular, there are these two loss-absorbing buffers, the capital conservation buffer and the countercyclical capital buffer, that I'm sure you are familiar with. And the macroprudential objective of the time-varying dimension of these buffers is, on the one hand, and primarily, to increase the capacity of banks' capacity to absorb losses during downturns while providing credit to the economy. And second, to make it more costly to expand the balance sheets during expansions in order to mitigate excessive credit growth during those at that point of the cycle. Now, supervisory stress tests have become the other one in many jurisdictions like the US, the UK, and also at the euro area level. Another instrument in order to assess the adequacy of the capitalization of banks, and why all of a sudden supervisory stress tests become a new element of the policy toolkit. The reason is that they were perceived as crucial. I mean, in particular, this cap stress tests conducted by the Fed in 2009, joined with, combined with a credible public backstop, were perceived as crucial in reestablishing the confidence in the U.S. financial sector. So partly because of that, maybe not only, but partly because of that, they have become part of the new policy toolkit, and not just as a crisis management tool, but also as an instrument very important in order to set banks' capital requirements also during normal times and during expansions. So in a supervisory stress test, the authorities define exogenously an adverse macroeconomic scenario, and then the losses that each bank would, the capital losses that each bank would suffer under that scenario are estimated. By doing so, supervisory stress tests are able to capture the effect of common exposures and correlations within banks, something that the risk-weighted capital requirements of Basel are not able to capture. So in this sense, supervisory stress tests are add value to the portfolio invariance risk-weighted capital requirements of the Basel standards, and are a useful tool in order to ensure the resilience of banks against negative shocks. Also, there are currently central banks, and not only, other institutions, investing massive resources in order to try to capture the dynamics of crisis events, try to capture, model how negative shocks may amplify through the working of the banking sector, mainly by capturing the interplay between illiquidity problems and solvency problems, fire sales, and the leveraging. And this is work in progress, but something in the future we may expect of stress tests. And those two elements, correlations within institution and the potential of capturing the effect of common shocks at the aggregate level, have made policymakers praise these tools as potential to enhance the macroprudential approach to banking supervision. So after this long background, what our paper and this presentation is about. So what are the questions we ask ourselves, and what are the answers? So we have two instruments to set capital requirements. The question is how to integrate the capital implications of stress tests within Basel III. Our answer to this question is the introduction of a stress test buffer that is additional to those in the Pillar 1 of Basel III. And that depends on the stress test capital losses that each bank experiences. And this approach is different, related but different to what has been usually done in the past, in which the results of the stress test were usually presented as in terms of a pass-fail, and in case of failure, capital measure of the capital shortfall. The second question we ask ourselves is, okay, Basel III has some macroprudential elements. Supervisory stress tests could enhance also the macroprudential approach to banking supervision. But when we put them together, how do we ensure macroprudential coherence? And our answer to that question is we have to conduct stress tests with procyclical severity, meaning that severity has to be increased during expansions and has to be decreased during downturns. And this is the way to achieve a counter-cyclical approach to, so it may be a little bit misleading talking about procyclical stress tests, but the way procyclical stress tests in their severity are a way to go against the buildup of financial imbalances, a way to go countering the cycle. And finally, in terms of implementation, how should we implement in a predictable and transparent manner stress tests with cyclical severity, also taking into account the risk of the so-called inaction bias, and something that for those who are not familiar with, I will come on the issue later. And our answer is following a constrained discretion approach to severity choices that is based on a simple severity measure. We all talk about severity of stress tests all the time, but we still don't have a measure of what severity is. And this is, in my view, a problem that should be fixed. So we have to rely on simple severity measures of the scenarios chosen by the authorities, and the authorities should follow a constrained discretion approach based on a rule for severity choice. So let me go to the first question, how to integrate stress tests within Basel III. So Basel III introduces two buffers, the countercyclical capital buffer and the capital conservation buffer, whose aim is to absorb losses during downturns. Stress tests estimate the losses that banks would suffer under an exogenously specified macro adverse shock. And the goal of stress tests is to ensure the resilience of banks with respect to those events, negative events. So it seems natural to use stress tests to measure to what extent the two Basel III buffers are enough to accommodate, to withstand the losses stemming from that macro shock. So formally, we propose to define the following stress test buffer, something that we call stress test buffer, and which is basically the difference between the capital losses that the bank would suffer under the adverse scenario defined in the stress test, and the aggregate of the two Basel III buffers. When the buffers are above the bank estimated losses, the stress test buffer would be 0. When the losses exceed those two buffers, the stress test buffer would be positive. And we propose to set this stress test buffer as an additional capital requirement, additional to those already in Basel III Pillar 1, and both the minimum and the buffers, and to make it transparent, to disclose it. A nice property of the stress test buffer is that it transforms the stress test results into the Basel language of buffers, instead of talking about in terms of pass-fail and capital shortfall, which is not the usual. So it kind of achieves an harmonization in terms of terminology, at the cost of introducing an additional buffer in a world in which there are already a few ones. So let me give you an illustration of, because everything will become clearer, I hope. So we have a bank. I cannot use the pointer, right? Okay. So we have a bank that has some minimum capital requirements, and also if the bank is systemic, some GSIIB buffer, globally systemic important bank buffer. And it has some countercyclical and capital conservation buffer. We conduct a stress test buffer, and one of the banks, Bank K, has a low exposure. So its experiences or supervisors estimate the losses under the stress test of this bank to be low. So that's the capital, the usable buffers are enough to accommodate these losses. In this case, Bank A would experience a stress test buffer of 0. Then we have Bank B, which have a higher exposure to the shocks that have been included in the adverse scenario. Supervisors estimate the stress test losses to be high, so that the capital conservation and countercyclical capital buffer are not enough to absorb them. And as a result of that, after the stress test, the Bank B would be subject to an additional positive stress test buffer that is equal to the difference between the two. I hope so far it is clear. So let me make a brief comment on what is the relationship between the stress test buffer and the GSIIB buffer. Indeed, the way we propose to define the stress test buffer is completely unrelated to whether or not the bank is systemic. So in the computation of the stress test buffer, we compare the stress test losses with the capital conservation buffer and the countercyclical capital buffer. The result of that is that systemic banks will be subject to higher resilience standards. Let me illustrate it in the figure. So here we have 2 banks before the stress test. One of them is systemic, Bank A is not systemic, so it doesn't experience, it is not subject to a GSIIB buffer, and Bank B is systemic, so it faces a positive GSIIB buffer. The way we have defined the stress test buffer is such that this buffer will be the same one for Bank A and Bank B. But since we propose the stress test buffer to be additional to the other Pillar 1 buffers the bank is subject to, as a result of the stress test, Bank B will be subject to higher aggregate capital requirements. So there could be, even though the purpose of the GSIIB buffer is also to give more room to systemic banks to accommodate losses during crisis, we conduct a stress test with same severity for both systemic and non-systemic banks. And we don't take into account that we want systemic banks to be more resilient because their potential failure creates a lot of distress in all the economy. We need to set higher standards in what the hurdle rate is for systemic banks in the stress test in order for this to transform in higher resilience standards for systemic banks under the overall capital framework. So that's why we don't allow, in our proposal, systemic banks to use their GSIIB buffer to absorb the losses that arise from the stress test. Let me go to a brief description of how the stress test buffer is related to the capital shortfall measure that has been usually used in presenting the results of stress tests, and how it relates also to the voluntary buffers that banks hold on top of the regulatory requirements. So in this figure, I illustrate two banks whose only difference is their voluntary buffer before the stress test. Bank A has a low voluntary buffer, and Bank B has a high voluntary buffer. But both of them are subject to the same regulatory requirements. And both of them experience the same stress test losses under the exercise. So in the case of let's start with Bank B. Let's look at a Bank B that has a high voluntary buffer. The result of the stress test is a positive requirement of a stress test buffer because the stress test losses were above the addition of the CCYB and CCOB. So Bank B faces a positive stress test buffer, but since it was holding a voluntary buffer for the stress test that was large, it is able to accommodate these additional capital requirements out of a reduction of its voluntary buffer. So now, and that's why we think disclosure is important. Now, okay, I should rush. Market participants realize that not all the voluntary buffer is anymore voluntary. Part of it is a regulatory requirement. In the case of Bank A, that has a small voluntary buffer, the new stress test buffer requirement would lead to a capital shortfall. And this is what makes because the voluntary buffer is not enough to satisfy the initial requirement, this is what links to the capital shortfall measure, the link between the stress test buffer, voluntary buffer, and capital shortfall measure. So let me go to the macroprudential coherence and how ensure that the Basel III standards and what supervisory stress tests bring to it end up being macroprudentially coherent. So bank's capital is a cushion that protects the debt holders of a bank. So we can kind of interpret bank capital requirements, requiring banks to hold capital, as requiring banks to operate under some resilience levels. So in a capital framework such as Basel III, in which buffers are built up during expansions to be used during downturns, we can interpret this capital framework as one in which resilience is augmented during expansions and reduced during downturns. So we let operate banks under lower resilience with a higher probability of default, to say it in a transparent way, during downturns than during expansions. And then macroprudential coherence, when we integrate stress tests into the Basel III framework, requires that the level of resilience embedded in supervisory stress tests follows the same cyclical path And what is the resilience, the level of resilience required by stress tests is very much related to the severity that we put in the adverse scenarios. So this means that the severity should be procyclical. We want higher resilience during expansion, so severity should be higher during expansions, and we allow lower resilience during downturns. So severity should decrease during downturns. And let me illustrate it with this slide. So imagine in this slide we have we illustrate 3 points of the financial cycle. One is an early expansion. 2 is the peak of the cycle, and 3 is a downturn. So on the left-hand side we have the Basel III standards, in which, as you see, they have this time-varying dimension that comes out of the countercyclical capital buffer. So buffers are increased as we get to the peak of the cycle, and they are decreased. If we conduct stress tests with a constant severity, as is shown in panel A, the upper part of the slide, stress tests with constant severity, which lead to the same stress test losses all over the cycle, the resulting capital framework exhibits constant aggregate capital requirements, because there is basically, to the extent that severity is constant and stress test losses are constant, there is any increase in Basel III buffers is just offset with a decrease in the stress test buffer, so that in the end, the overall capital required to banks is constant. So we lose the time varying aspect that is the key aspect to ensure that we achieve the macroprudential objective of enhancing financial stability and leaning against financial imbalances. Instead, if we conduct procyclical severity, in which the stress test losses increase as we increase the severity along the cycle, the resulting framework exhibits, that you see in the bottom right panel, exhibits the time-varying macroprudential dimension that we are looking for. And I mean, let me go very, very briefly on
conclusions.
Yeah, I will go. So just the implementation. No, I want to be critical. So on our proposal, and very fast say, our proposal is easier said than done. And but I'm sure Benjamin will say a lot about this. Easier. It's not so easy, because we have to define what severity is. How do we measure severity? And then how do we ensure that we are severe when we have to be severe, despite the likely opposition of banks that won't like to see their capital requirements further increased when things look during expansions that it seems that there is no risk anywhere. And then maybe this is something we can leave for the discussion, kind of a comparison across jurisdictions between what is the different approaches to stress testing in different jurisdictions. Just to say it in 5 seconds, our proposal is not
Co-American.
Is
Co-American.
I say it's more to go UK. It's just, we are not revolutionary, so we are kind of it's broadly in line with the current approach in the UK, with some differences, and it's in line also with the current approach in the United States. It will be even closer with the announced, the US has, the the Federal Reserve has recently announced some modifications on the way they are going to conduct stress tests from the 2018 cycle that has some further similarities to our proposal. And so, I mean, just to conclude with the last bullet point of my conclusions, and just as a way to give the word to Benjamin. So the definition and implementation of a policy framework that follows our proposals, so that is broadly in line with our proposals in the euro area, is maybe more challenging than in other jurisdictions, because in the euro area there are many countries with heterogeneous positions in the financial cycle, and we have to design adverse scenarios that we should define adverse scenarios that take into account that heterogeneity. So it is more challenging. It is a much more difficult task, but I think it's equally necessary.
Okay. Thank you very much for this presentation. Then we go to Benjamin, whether you think it is feasible and whether it is desirable.
Okay, well, thank you very much. Firstly, thank you for the presentation, and well, thank you for the opportunity to comment on that. And indeed, I think my comment will be more on the practical aspects in a way. First of all, I'll also have to make a couple of disclaimers. The first disclaimer, as always, whatever I'm going to say are my personal views and not necessarily the views of the EBA. Second disclaimer, well, I work for the EBA, which is a macroprudential institution, so my views might be slightly biased from that side. Third disclaimer, at the EBA, I'm responsible for the work on stress testing, particularly the methodology and the coordination of the EU-wide stress test. So, of course, when I read a paper on stress testing, capital buffers, everything, I see as from the perspective of the EU-wide stress test. But let's start with the paper. So, I mean, there are three main points in there. One, I won't really comment a lot on, which is it would be good to have a robust and simple measure for severity. And indeed, that would be very good. It would be great. We'd be very happy if we had a measure like that. So far, we don't have one. But any ideas are very welcome there. Then almost the main comment is that stress tests, or the severity of stress tests, should be procyclical. And there are a couple of, I'd say, underlying statements which I will comment on, like that the countercyclical capital buffer, the capital conservation buffer should be part of the stress test buffer. There should be a stress test buffer, and the whole thing should be consistent with the Basel III framework. I think for me that's one big combined statement. And then the last one is the sort of constraints for supervisors or for authorities to set the severity. You call it constraint discretion. So my comments will focus on the second one, and I mostly think of the objectives and the implementation of stress tests. And I also have some comments on the more, let's call it policy or governance implications. Okay, so first of all, the statement that we need a stress test buffer. Well, I think that's well established. So in the EU, we've done several EU stress tests. You mentioned the Fed stress test, indeed, or the Bank of England. Other authorities have similar frameworks. So I think there are few people who would not say that stress tests are a good tool to look at the capital adequacy of banks. In fact, that's what we've been doing the last couple of years. And it's a requirement. So in the CRD, that's a requirement for supervisors in the EU on an annual basis to carry out supervisory stress tests in their assessment. There are also EBA guidelines dealing with that topic. So I think this sort of idea of a stress test buffer, although we don't call it stress test buffer, just to make things more complicated, we call it capital guidance, not capital buffer, is, I'd say, well established. But there are a number of open issues. And I think then in the paper, you deal with very important open issues, which is the interaction of different buffers, and in particular, let's say, the interaction of macroprudential and microprudential buffers, which I think is a wider topic than what's in the paper, but it's still, for me, it's an open issue. This is a very relevant issue. Then the next question is the way it is approached there. So I would say the question, if a stress test buffer, I just stick to the terminology of the paper, should be pro-cyclical, it's very related to the objective. So in the EU, our objectives, again, I'm taking the example of the EBA, we have the objective to run a stress test to assess the resilience of financial institutions to adverse market conditions. That's a very broad objective, but still, I mean, what we do is we look at a scenario which we think is credible, that is then designed by the ESRB, in fact, and the objective is to see whether banks can actually withstand such a shock. And that is the main question. It's not necessarily then pro-cyclical. So you mentioned the stress test we did, I mean, 11 and 14, that was more crisis management. So indeed, what we did, we asked banks to increase capital in a crisis. It was a crisis management tool that by definition is not really pro-cyclical. Well, so that's not a pro-cyclical severity, it's the opposite. But I think no one would say that we shouldn't have done that. In the end, we shouldn't have asked banks to release capital in 2011 because there was a problem with confidence in the banking sector, there was a problem with undercapitalization that had to be fixed. So, as I said, it's part of the objective of the exercise. Another example I have is a stress test. Doesn't necessarily have to be based on a broad macroeconomic scenario. We could do something completely different. So we could think of a stress test with a completely different focus. So let's see, what if we had a stress test that looked into just conduct risk and cybersecurity, which could be a valid thing to look at for banks to see whether, or actually for supervisors to see whether their banks could withstand such a shock. Then the link to a capital conservation buffer, link to the countercyclical capital buffer is not that strong anymore. Similarly, with more typical topic, Dirk mentioned at the beginning, real estate. Of course, stress tests are often used as a tool to see what happens if some sort of real estate bubble bursts or if just real estate prices crash. And that is cyclical in nature. It's not necessarily exactly the same risk which is being looked at in the countercyclical capital buffer, which looks at the broader economy. So I'd say this interaction between those buffers is unfortunately more complex, and whether there is an overlap depends on the objective of the stress test and whether it has to be, the severity has to be adjusted through the cycle, again, depends on the objective of the stress test. Let's talk a bit about this constrained discretion approach that is proposed in the paper. And I think that's very linked to what I just said on the objectives. So if the objective is to just assess resilience in a specific scenario, constraints could actually be risky. So if there is a credible risk that competent authorities plan to look at, they probably shouldn't be constrained. And I mean, that's also what we do in the EU-wide stress test. So we base it on what is seen as the core risk. That could be something like a global macro-financial shock, could be a shock to risk premia on a global level. How then countries react depends on how volatile these countries are, how they are exposed to this shock. That doesn't necessarily mean that we need to look at the credit to GDP gap. And in fact, I think it's one of the metrics the ECB doesn't look into too much in this scenario because they want to know how these shocks then affect different countries, and competent authorities want to know what the shock will do to their banks. So it's a very different way of looking at stress test scenarios. And I think there also the consistency within Basel III and the severity is less relevant. So it's a very different, as I said, very different objective. So in a nutshell, putting these two things together, I think the framework that's proposed in the paper in practice would be more complex to implement, and it deals with a very specific situation. So when I read the paper, I always thought it looks a bit like a calibration tool for the countercyclical capital buffer, but there might be other things to look at in stress testing. Then I also do have some comments on what I say the policy implications. So if there was such a buffer, where should it be? And so I said in the beginning, in the EU, we don't have it in Pillar 1. In fact, it's Pillar 2. And in there, it's not a requirement, but it's we call it capital guidance. So stress test results, like in 2016, that we did that for the first time, should form then the basis for guidance for banks for additional capital to be held. And the reason for that is, firstly, that's, I'd say, intrinsically counter or procyclical. I'm not sure which term to use always, but I think we all mean the same thing, because this sort of capital guidance is something that's not a requirement through the cycle. So meaning, if banks have that capital, it can actually be used in a crisis. I think we all agree on that. I mean, if we ask banks to hold capital based on a stress test and the stress happens, then the capital should also be there to be used. But not saying it's a requirement, not a Pillar 2 requirement, but guidance makes it usable, I'd say. So that's one argument for having it in Pillar 2. And another argument would be, again, I have to say the world is complex. We've seen that in the EU-wide stress test. We don't only look at just the quantitative stress results. We have to look into other things. We have to look into how the stress test from the objectives interlinks with existing capital buffers. That's, as said in the paper. We also have to look into things like what mitigating actions have banks taken or which are planned. And all of those then form all of those combined then form the capital guidance. And that just cannot, this is a discussion that can only take place in this REP, so under Pillar 2. Last comment on the policy side. I think you didn't mention in the presentation, but I still have to comment on that. In the paper, there's this division between the UK and the Eurozone from stress testing. Well, I work in an EU institution, so far I'd say we don't have that split. If we need a stress testing framework, it should ideally be on an EU level. And in fact, many of the things in the paper, they don't just touch upon the responsibilities of competent authorities, but actually EU law. So the buffers, for example, they're EU law. And in fact, on some of the topics, the EBA is currently working on to give some more guidance. So firstly, on the stress test framework, and also in particular on this issue of Pillar 2 guidance instead of Pillar 2 requirements, those are topics where we're working on and where there will be more, let's say, more guidance than for banks and for supervisors, but on an EU level. I think I'll stop here.
Thank you very much, Benjamin. And you said you gave the micro approach from the European Banking Authority. We would have had a second discussion, Carmelo Saleo from the European Central Bank, but our friends from Lufthansa are on strike, so he couldn't fly in. But I'm in the Advisory Scientific Committee of the European Systemic Risk Board, which meets at the ECB. So I will then take now 2 minutes as multitasking chairman to do the macro side, because I think both sides are needed for the discussion, and then we open up for questions. And if I look at the proposal from a macro side, complementing the comments from Benjamin, and I think it's quite clear. If you test for other purposes, then the cyclical thing is not coming in. But if you test for cyclical things, like most stress tests have an underlying economic scenario, I think it makes sense, because if you're in the upturn, then you want to slow down, and that you put this thing into your stress test, I think makes a lot of sense. Then the issue how to do it, that's always very difficult, but a simple version of the financial cycle is defined as housing price growth and credit growth. Claudio Borio was one of the first to do that, 50-50%. And if you really look at it, they are extremely closely correlated, because housing price growth is financed by mortgages, so they are more or less the same. So the difference, and anyway, if you look at bank balance sheets in Europe, 60 to 70% is mortgages. So in the end, banks are quite close to what's happening in the housing and the mortgage market. So I would say that what happens to house prices is at the core of the cyclical pattern, that we happen to define cyclical by credit to GDP. That's the Basel definition. But given that mortgage is part of credit, I would solve that problem that if you look at credit growth, you look for 90% including what happens to mortgages. So I would say you're quite close there. The second issue on the analytics, I was really happy that you took the GSIP capital charge separately, because in macroprudential we always make a distinction with what are your cyclical instruments and what are your structural instruments. And the GSIP is really related to too big to fail. And that is not a cyclical issue, that's a structural issue. So if you get more capital because you're too big to fail, then that should not be part of the cyclical buffer. So I fully agree with you on that element. And then a final question is, of course we have to do it at EU level, but then in the end you do an implementation also. Then my big question is, would we execute this at the ECB level? So you do a differentiated approach. So if you're lower in the cycle, you get a lower stress test scenario. But still the ECB protects the integrity and the consistency. Or would you propose to do this at the national level? So who should set, so even if we all agree that we do a cyclical scenario, which is very controversial, like I said 2 weeks ago when we had this review of macroprudential policy, but even if we sign up, should that in the euro area happen at the national or at the ECB level? I give you 2 minutes for reaction and then we open up the floor.
So you want me to ask?
On this, and maybe you have also a comment on Benjamin.
Yeah, I mean, I start with your last question. I think this is the ECB. I mean, ECB is under the SSM is in charge of the supervision of euro area banks, at least of significant banks. So the scenario design indeed is done by the ESRB, and so not by local authorities. We are not proposing local authorities to get back into their perimeter the conduction of stress tests. We are just saying that the domestic cyclical position has to be taken into account when it comes to designing the adverse scenario. So countries that, for example, measured through those two indicators of the financial position in the financial cycle that you just mentioned, like credit growth or credit to GDP gap and housing prices. We should look at those two indicators at the national level in order to calibrate the domestic parts of the adverse scenario, so that countries that are experiencing a housing boom that will come certainly associated with the credit boom should be subject to a higher fall in GDP under the adverse scenario and a higher fall in housing prices under the adverse scenario than countries that are not in that cyclical position. When one looks at in the paper we just did a scattered plot on the like very simple measure of severity, which was the GDP fall in the last EBA ECB stress test, and we plotted the different credit to GDP gaps of the countries at the EU level and the GDP fall in the last in the adverse scenario of the last stress test. And what comes out of that scattered plot is nothing, just lots of points with no clear pattern, which from a macroprudential perspective, whereas from a macroprudential perspective, we should see a clear pattern in which countries with a very low, very negative credit to GDP gap should experience a very low fall in GDP under the other scenario. We don't see that. So this was...
Okay, I think I now open up because
yeah, okay.
We have a microphone, and please say where your name and from which organization you are. So who can I hear at the front?
Yes, my name is Sigurd Schmidt, and I come from an institution called Coherent Economics, a consultancy based in the Scandinavia area. I have a question maybe for both of you, and that has a bit to do with the nature of the stress test and the link between the nature of the stress test and the motivation or the logic behind having pro-cyclical, what you call severity. Because if you do a stress test, a proper macroeconomic stress test, then almost by definition, the risk of losses should go up in an upturn, in the sense that the structural value, for example, house prices, would come further apart from their structural long-term levels. So I think there is if you do the stress test in a meaningful, real macroeconomic way, you've already built into a cycle component of the stress test. If you haven't done that, I'll be very concerned about how you do these stress tests. I think that they are then constructed in the wrong way. Now, provided you have this very structural component in your stress testing, I fail somewhat to see the argument for that when you then convert it into your view on what the buffer should be, then you then do some kind of pro-cyclical review to it, because you built that into the stress test already. So to put it simple, you are at the top of a housing boom in an area I know of, Stockholm. And I think there's only one way prices can go, downwards. So if you do the stress test in the Stockholm area, and some of the big banks have done so, they go down, and there's a large risk, and they're trying to assess this. On the other hand, if you look at the housing market in Philadelphia in 2010, you would see that house prices were probably below construction cost, and you know there's only one way prices could go up. And I think proper stress tests reflect on this. So I'd rather see, and that's a question to you, the argument, if you do the stress test in such a meaningful way, why would you then also want to have some kind of pro-cyclical use of these stress tests for setting capital buffers?
Okay, so I'm happy to kind of interpret that you think meaningful is procyclical. I mean, when it comes to the shock on housing prices, it is very clear that what one would expect when we are experiencing a housing boom is that if you want to shock, you have to put a very, very embed in the adverse scenario a very important drop in house prices. So meaningful and macroprudential coherence go hand in hand. But imagine, let's say now, I don't want to talk about Italy because I come from the Banca D'Italia, nor of Spain because I'm Spanish, but let's talk about Greece. I mean, I don't know the exact figures, but Benjamin knows. But in the last EBA ECB stress test, the GDP fall in Greece was, I would say, along the adverse scenario, was close to 2 digits. This is a country that has already gone down by 2 digits in the last in GDP in the last 8 years. I mean, is it meaningful? Maybe it's more likely that for whatever reasons, not only related to economic but political tensions, that the Greek economy might go down by 7% than the German economy go down by 7%. So here is where the macroprudential coherence may go against what meaningful means, and that's why we need a framework in which we realize that resilience, the level of resilience, we could require banks to operate under 100% resilience level, just equity funded, but that sounds like not meaningful. So the macroprudential...
Yeah, but the short question is, if we do the cycle properly into the stress test, are you happy? So if we define meaningful as, so it depends on where you are in the cycle. So if we do that properly, are you then happy? And then you only argue for a consistent framework.
No, I think I wouldn't be completely... It's not just about likely, it's just, I mean, we have to be willing to accept that the banking systems of countries that are doing bad operate under lower resilience levels. That's what macroprudential means.
Yeah, but that comes out of it, because that's exactly, because if you have a weaker stress test because you are already further down, so you theoretically you should not go down much further, then you get automatically a weaker stress test than compared to a country who's like in Stockholm was in the boom.
Yeah, if I may add to that, so I think it's a very valid point, and that is also something we do in the EU-wide stress test. So it is exactly the kind of discussions we then have with the ESRB who designs the scenario. So meaning a country that has just a large boom, the housing market, you mentioned Sweden, what would be a shock there compared to other markets? You will then see in the scenario that I think Sweden has the largest real estate shock. I'm not 100% sure, but that's what I think at least. Indeed, then the discussions are, how likely is it in a country that just had a 45% decrease in real estate prices to have another 45% decrease in real estate prices? So even if we look at a roughly equal severity, I think with some sort of more, a simpler measure just on GDP, like the last stress test was probably a bit more severe than the one before, but very comparable. Even there, the underlying shocks then can be very different. That's your point. So the losses then in certain portfolios can be much larger. And that's built in. There's more to it. That's why you don't find it in a scatter plot, because some countries might be more volatile than other countries depending on the shock, but still this is built in. I think that paper goes one step further and says you shouldn't leave the severity unchanged, but even change that, which would give it an even bigger procyclical impact. That's how I understand it.
Is that correct? That you do it double?
I mean, since I think we are on the same foot when it comes to the housing prices, I come back to the Greek example. Under our approach...
Yeah, but we can keep on talking about Greece, but there's also like a small percentage of the euro. So let's take another country which is quite large. Let's, for example, take France, which has a different cyclical than, for example, Germany. They see also that effect. So if we put the whole discussion on Greece, then I find it a bit difficult. So
no, I went to the extremes. So the point is also that, I mean, talking about severity it is difficult to talk about severity in a serious way when we don't have a measure. So let me go to, if you want, to your first question on any ideas on stress test severity measure. So the Federal Reserve has done some work on that direction, and also on rules in order to choose severity. For example, they consider that the most important macroeconomic variable on which to build the entire adverse scenario is the unemployment rate in the US.
Yeah.
And they have the following rule in order to set the path of the unemployment rate under the adverse scenario of their stress test. The unemployment rate should attained under the nine quarters horizon on which these stress tests are conducted. It should at least attain a 10% level, and it should at least increase by 4 percentage points. So in this way, when you see, when the U.S. economy is experiencing an expansion, the unemployment rate is very low, let's say 3%. Forcing the unemployment rate level to get to 10% means that the unemployment rate will have to increase at least by 7 percentage points. When the economy is in a downturn and the unemployment rate is already high, the increase in that variable under that scenario is smaller. So this is the kind of things, not so related to something really difficult to measure, which is the likelihood. The likelihood of the unemployment rate going, when it is at 9%, going up and down.
No, but there's a clear case to do that. And then the second question is, given that the financial cycle, if you take the Boreal people, is always credit and housing, and then the US is introducing unemployment, which is different, because I think the BIS people are always afraid that if too much credit goes into assets, well, this is more a hardcore macroeconomic variable unemployment.
But for example, to the extent that just to finish, to the extent that real estate is so important for the outcome of the stress tests, fixing clear, and I think on housing prices, it should be, fixing clear rules in terms of how on the deviation of housing prices with respect to long-term trends. This is something that is worth to try.
Yeah. Okay. A question there, and then a question.
Tommy de Temmerman, European Commission. Two questions. The first one is, why would you want to put your buffer as a Pillar 1 measure for something that is fundamentally bank-specific and is usually dealt with in Pillar 2? What is the reason behind this proposal? And another question between the interaction between micro and macro. So you want this buffer. You want it to be softer in difficult times, difficult macro times. How do you reconcile that with the need for your stress test to be seen as credible on the micro side, and not to be dismissed as some sort of cover-up because it's and not acknowledging the state of your banking system in the downturn?
Okay, then I collect questions.
Marek Dąbrowski-Brugger. I have a question more general about capacity to predict macroeconomic future. Because all this concept which you discuss are very nice concept, and I would say intellectually correct, but then we come to implementation. And first question when we discuss countercyclical buffers is, for me, not obvious where we are now, for example, from the point of business cycle. For example, in Euro area, we are at the top of business cycle, on the bottom, or somewhere between, or maybe already we passed already the top of business cycle. So this, I think, is quite important question. But then we have also, apart from business cycle, also financial cycle, which we just addressed. And actually, we know from the experience of another exercise, stability and growth pact and excessive deficit procedure, that this is a quite tricky problem. That, well, as far as you can take assumption about regularity of business cycle is more or less fine, but we don't have regularity of business cycle for various reasons. And also in case of stress tests, which are more bank-specific, but again, you must
take some macroeconomic assumption, unless you limit the test, as you suggested, to things like internal management or cyber security. Then, of course, assumption about macroeconomic perspective is not unimportant. But basically, I understand that, again, we must have some ideas about where we are and where we will be macroeconomically in the future. Thank you.
Thank you.
Okay.
Yeah, so the first question regarding whether we should interpret our stress test buffer as Pillar 1 instead of Pillar 2. I mean, what we think is really important on top of the definition is that the requirement is transparent. It is disclosed. So Benjamin talked about this concept of capital guidance that to me, but this maybe this shows my lack of knowledge, is kind of an obscure concept. So, or in terms, I think much more transparency on.
Bankers call it the black box of SREP. It's
on
getting
how,
to be opened.
So our point is how the stress test results should be transformed into capital implications for banks should be very transparent. Otherwise, we open the door for markets to start speculating on how. And so I think transparency on this issue is important, and that's why we propose to disclose what this what stress test buffer each bank is.
If you allow me to chip in, and then Benjamin, you have to say if you disagree. I would stick for Pillar 1 because it is a country-specific way of doing the stress test. That it differs by bankers, of course, because they have different exposures. But the idea of having different cycles, either for housing or for unemployment or for credit growth, these are country-specific and not bank-specific. And I'm afraid that whatever we do, we say, okay, let's do Pillar 2. So in the end, the whole world is Pillar 2. So I would side with the Pillar 1, given that it is that we want country scenarios rather than bank-specific. So in that sense, I see the logic, if you will do it, then to... but then the key question is the credibility. So the
credibility,
the micro-macro...
I understand that, and that will be more difficult for us. That I mean, what is important is that the public at large and the banks in particular, who are mostly interested in these instruments, understand what is our policy framework along the cycle. So to the extent, I mean, to the extent that we are able to justify why, because we are not just trying to put the problems under the carpet, the current problems under the carpet by not conducting stress tests of very high severity in some countries and not others. And to the extent that we are able to communicate, and the Bank of England is doing that. It's true that their economy is now or was expanding, and they were forecasting an economic expansion. They realized that a counter-cyclical approach to stress testing was necessary, and they have done a lot of an important communication effort in order to try to convey what is the idea along the whole cycle of how they are going to conduct the stress test. Of course, now they will, if the economy continues growing, they will keep on increasing the severity. When the cycle changes and they enter into a downturn, they will have the credibility to say now it's they will have gained some reputation to say now it's not the moment to shock
But that is the UK, and I think you are thinking of also the credibility for other countries. So let's face it, let's not take your own country where you work, but let's take Spain and Portugal. So you introduce this technology when you are at the bottom of the cycle.
No, but that's why that takes me back to your initial question. This is the ECB. It is the ECB who has the institution which has to design the adverse scenarios, of course. And it is important to be able to communicate why we are shocking some countries more than other ones, and because if investors interpret our more weaker shock in some countries as a way not to make problems emerge, there will be, the stress test won't be credible. So to give a final answer to your question, yes, we are in a tough situation in order to gain credibility, to have credibility under our full proposal in this current cyclical situation.
So yes, the question of Pillar 1 versus Pillar 2 and bank-specific versus country-specific. Well, I have to say, sorry, again, that depends on the objective. So if the objective of the stress test is pure real estate dampening credit growth or a really pure real estate macroprudential measure, you might be able to do that on a country level. If it's a stress test like the EU-wide stress test, we see that the results and the impact actually varies massively by bank. These are really bank-specific things. And we looked at that. It's very difficult to correlate the impact just to the country of the bank. So that would make it indeed very bank-specific. So when we talk about macroprudential real estate, yes, country fine, stress testing is bank-specific, and then puts it almost automatically into Pillar 2. So one of the things I said is there are other things to look at, like mitigating actions, for example, of the bank, which has to be done in a Pillar 2 discussion. But there are also other aspects. So, I agree, Pillar 2 is, at the moment, is less transparent, but, could in theory be more transparent. That would be one thing. And then all capital requirements which are in Pillar 1 have, I'd say, one disadvantage. They are in a way transparent because you see it directly in a report from a bank, but it gets difficult to compare across banks. We already have that situation because we already have macroprudential tools that allow a change in Pillar 1 risk weights, which are partly based on stress tests. We're in Belgium today. Here we have this sort of adjustment. So these tools are calibrated on stress tests. And now when you look across the EU or across wider regions, you look at the risk weights of banks, then the question is, what do they tell you? Is it because of scenario analysis? Is it the rating? Is it the portfolio distribution? We have different stress tests. We run stress tests on minimum requirements, which are based on stress tests. So lots of complexity are coming into the picture here when you adjust the Pillar 1 risk weights.
And the macro question, the credibility.
Well, yeah. Obviously, that's a question which is very, very dear to my heart. So thank you for mentioning that. The credibility would be a major problem indeed if we went for more pro-cyclical scenarios. So, we for the EBA or the EU-wide stress test, we get that pressure all the time. So if something went wrong in one country, even though a model might say now it's less likely that we'll see another GDP contraction, we're not only looking for a academically right probability level, but we have also other objectives like what do we see as what could happen, or what is really the credibility issue or the confidence issue? How can we restore confidence in the sector? That might require indeed a severe scenario on top of something severe that has already happened.
And then the key question is also the final question, capacity to predict. because I think it was a very wise question.
It was a very wise question. I actually have it somewhere in my notes. I think I wanted to make the same comment, but I forgot. So thank you for that question, and thank you for reminding me. Obviously, if we knew when we design, actually when the ESRB designs the scenario, if we knew exactly what would happen next year or the next 3 years, it would be fairly simple to be pro-cyclical. We'll say, okay, now we're at the trough. Now everything can only be better in these 3 countries. Therefore, we don't need a severe stress test. They will definitely make a profit next year. They will increase capital. Yeah, but unfortunately, we don't. We can only talk in terms of probabilities based on historical data. Is it likely? Is it unlikely that something happens again? So there's always some sort of expert overlay.
But for example, maybe you can come in because you're in Sweden, so you the one of the 2 countries with the counter-cyclical buffer active. And how would you approach it? Because I think Marek had a good question. It's often difficult, I think, but in Sweden you are aware of the risk of your upturn or not?
I think just to, certainly not a big expert on banking regulation, I think one need to think about what are the objectives of macroeconomic policy and what are the objectives of bank safety policies. And as I see the Pillar 1, Pillar 2 discussions, basically a question of DEFCON evolution. So, and therefore I'm putting a bit weight on what you're saying about mitigation actions. And if you see specific risk attached to one bank or group of banks, then there's a signal from stress tests and otherwise that the bank needs to address the specific risks that are giving them bad scores in the stress tests. I think, therefore, I think while the minimum level is, in my view, also set in to basically to ensure that if something went really wrong, before the state started to do recapitalization, so there will be a sufficient level of solvency for the taxpayers not to pay. So there is this escalation of, and therefore there's this extremely good argument for having minimum weights and a buffer where the monetary authority or the banking regulation have the means to engage with the bank so that it doesn't run down to the minimum weight. Now, in Sweden, I'm not Swedish, but I work for some Swedish bank customers, and of course there's a big discussion in Sweden right now. And I was in a banking conference 2 weeks ago where the Director General from the Finansinspektion, the Swedish BaFin, if you like, were very much calling for macroprudential regulation, like total income, total house price to income ratios, which is micro to macro. And all the big CEOs from the big banks said, well, sorry, we have done stress tests, pretty tough ones, on the and basically we are home safe. So this whole discussion of where is micro
but
macro.
that's the interesting thing, because in Sweden they have this difficult thing that also the macroprudential instruments are with the supervisor, not with the central bank. But then maybe the banks are micro safe, so the stressors say that the banks are safe, but who's slowing down housing price growth then?
Yeah, but then I think that's where you're just inviting me.
Yeah.
Because I think here we need to think about what is the role of bank policies and what is the role of macroeconomic policies. And what's driving house prices in Sweden, in the UK, everywhere is migration to the big cities, pushing up prices, and then you have crazy monetary policies in Sweden, minus degrees.
Everywhere, QE.
So, QE and all this sort of thing. So is it really then, okay, we have crazy monetary policies, we have migration to the cities, then we need to have something on top on banking policies. You could also do something about tax policies that discourage house prices. You could do something about monetary policies, and you could do something. So how much burden do you put on the banking regulation? I think that's part of it.
Can I ask then another question? Because if you say monetary policy is absent because we have QE and we live in an international world, then if we don't do too much with banking policy, now with tax policy we all know house owners are voters. So although the government is the ideal person, they are often even pro-cyclical with their housing. I'm from the Netherlands, and there we get interest rate deductibility, that's why we have extremely high house prices. The government is often the wrong one because they have the election cycle. So, but then nothing happens. So if the monetary is not doing it, the banking policy is not doing it, and then the government is not doing it, then the housing boom is happening again.
Yeah, and then the question is then how big. I mean, you just on the stress test on the Swedish banks, they have the lowest losses almost of any of the countries, and they have capital adequacy ratios 8, 19, and above. So, not to say that they cannot burn through this capital, I would be very surprised.
Yeah.
So the question is again, the kind of economic crisis that would be required to burn down debt, and before all the mitigating actions under Pillar 2 could be in place, would be World War III, in my opinion. So the question is again here, the balance, how much burden can you put on banking policies if what needs to break down banks is a huge economic crisis that must come from somewhere else. I think this is kind of the balance, and it goes also a bit for me to the whole idea about having counter-cyclical elements built into this, because is it basically a supplement to economic policies not supporting growth in this situation? What is the purpose of it? I'm simply a bit questioning a bit. What is the purpose of it?
Any other questions?
Yes, to Jean-Luc Fépinier, EIB, two simple dummy questions. Have you thought in terms of implications for the optimal frequency of stress tests of your modeling, and also, of course, implications for resources consumption in the SSM and the EBA? And the question, I'm not familiar with the Bank of England's communication. How do they communicate, or how would you communicate then the country-specific cyclical position? There would be a component which is regional, or and another one which is country-specific? And the third remark, before those perhaps of the implications for competition policy stated, and I remember Gert-Jan Koopman mentioning the issue of basically losses under the adverse scenario being eligible for precautionary cap subject to state aid outside the resolution framework set out in the BRD. So questions about we go back to the issue of the credibility of a loss on display.
Okay. Would you like to take that, the frequency?
Yeah, so I mean, these stress tests they require massive human capital resources. So I think we cannot increase their frequency. So this is an annual exercise that gives you want a point in time view of the state of the banking system, and I think that's the right frequency. Then when it comes to the communication, there are two issues: the communication of the overall framework that has a cyclical dimension, and the Bank of England has done it has published an official document, and in which they presented their strategy for the next years when it comes to their approach to stress testing. And then in the current stress test exercise, they have relied on that framework in explaining how the adverse scenario had been chosen. Under our proposal of country-specific shocks in the euro area stress test, we should, of course, first develop this framework, explain what are going to be the main indicators to identify, of course, not in a perfect manner, the cyclical position of every country. And then when the adverse scenario is designed, we should make reference to those indicators so that the public sees the strong link between our policy strategy along the entire cycle and how we make severity choices, scenario choices for the different domestic components in each year stress test.
Okay, thank you.
I really don't have anything to add there. Also, I'm not sure how the Bank of England communicated that strategy. I'm not sure if there was a question on the use of stress testing in the aspect of resolution or not. If so,
I think it is fair to say, if we go to the conclusions, is that the Bank of England is at the forefront of cyclical thinking on financial policy, in the Financial Policy Committee, more than many other central banks. So in that sense, I'm not surprised that they are already partly doing these things, because they understand that macroprudential is about many things, but including the cyclical thing. And then I think if we conclude also, we come also to the bigger picture, I think, which you put on the table, the macroeconomic policy anyway in a country, what is the division between the different parties? And then it's a question of preference where you want to put it. And my only danger is that all parties find it too difficult to do, that nobody's doing it. So I think everybody should chip in. Because if there is one lesson from the US, and look at Ireland and Spain, is there were housing booms. With hindsight, they were completely clear. If we do the graphs, we all see them. But at the time, nobody was acting on it and seeing them. So I would rather have too many parties looking at these things than too little. So, but I think the conclusion is also it is not extremely easy to implement. Including the question is who can predict the cycle, because you talked about the peak. Well, the peak you can only observe afterwards when you have passed it. But I think the idea is interesting, that at least not what happens with the stress test and what happens with the capital framework, that at least that we think about it in a consistent way. I think that's the added value of today's discussion, that the two things should not be too separate. And also that we dare, and I think you reinforce that point also, that like a counter-cyclical buffer and a capital conservation, we have to dare to use it. So when the stress happens, then we should also be able to draw down on it. And not many supervisors dare to do that. So I think there we have agreement. And the lunch is waiting for us, but before that I would like to thank both the discussant and the speaker for a very nice morning.
thank you. By the way, you are aware that the Bank of England runs two scenarios. One is